Hey traders, today is March the 9th, 2021. It's a Tuesday, and I wanted to do another video once again on the importance of hedging. And I'm going to show a very quick clip here of a hedge that I did last Wednesday. So I believe that would be March the 5th, which was basically a broken wing butterfly that really had very little risk at all in it, but really enhanced the result of the trade, really enhanced the rate of return of the trade. It's just a simple example of enhancing or hedging on a trade, but that's not really the point of the video. I wanted to get in on this video and really explore the importance of hedging. So that was a great day, Wednesday the 5th. Then that following Friday, this past Friday, had about a $14,000 loss in my zero-date expiration trade on that particular day. Market just absolutely powered through, blew through my call legs. Had a couple call legs that it blew through, and even though I adjusted it, it still ended up as a loss. But I traded around the trade. I had a hedge going on with the micros, the MESs, on the E-minis, and was able to close those out finally today. So we started that basically around the 5th or the 6th or so, and was able to close them out today on the 9th at a $14,000 profit. So basically nullified that bad trade. And so I just wanted to talk about that here a little bit today, but I'll show you the hedge first on the broken wing butterfly. Screen? Still no screen? Oh my gosh. You guys just need to fire me. You just need to fire me. Oh, this is where did it go? Where did it go? Here it is. That's the trade right there. That's the trade right there. So it started out as just a long butterfly call, but it's basically a broken wing butterfly. So it's obviously got incentive to make money to the downside. I spent just under 400 bucks on it, 385 bucks or something like that. And it's got, $600 profit if you hit in the zone up in here, about $200 profit down here. Here's the trade itself right there. Let me capture that, and I will stick it in the trade tab. It's an interesting little trade. Whoops. It's an interesting little trade. Again, just using some of the money that I'm bringing in already. It doesn't have the eye-popping appeal that Fred's did the last couple of days. But it's an interesting trade. We'll see how that ends up here at the end of the day. Yeah, okay, that gets posted. William, what is green shot? Does that help me somehow? Because I need help. You guys know I need help. Green shot. I'll look at it. I just look at it in the risk graph, Sean. I don't think maybe Sean is in the Zoom, but snipping tool. Okay. Get green shot. I'll check it out, my friend. Thank you so much. I appreciate it. Okay, so man, we're just down to just over a half an hour, right? Left in the day. and just kind of boy, again, the hedges, the the hedges on the hedges, it makes all the difference in the world, right? Um, not that it's an amazing day for my micros, because I was up a couple thousand on the day. Now I'm down 1,000, but I got 800 or $900 of profit on the covered portion, and I can play with that now tonight. I can take that off if I feel like I've booked the profit and it's enough and we're coming back up. I can add to it. Just be really flexible with this. So we'll see. And again, I will. I, as I update this, I will post that in the Hedges channel. Um, our oil trade is looking okay. Our BYND trade, some of you got filled. I never got filled on that. Look at activity wise. Yeah, I'm still working at 21 cents on the call side on BYND, and the mid price right now is about 17 cents. So I'm not even close on that. I'm not sure how you guys got filled, those of you that did get filled on it. But anyway, pleasantly surprised. Pleasantly surprised with how well BYND has held up based on its technicals. If you look at the chart right now, it looks pretty ugly. And then, of course, the market overall today has not been favorable either. And so I think that bodes fairly well for tomorrow. Interesting that we're actually up on the day, right? Down overall because of what happened yesterday, but up on the day. I wouldn't have thought that at the open this morning. So kind of hanging in there. And then our SPY trade, again, it would be nice. It would be nice to get a call leg in on that, but we're going to need some help with the marketplace to have something like that take place. So we'll just continue here to watch our SPX trade. I'm going to, just for the fun of it here, I'm going to combine that butterfly on top of it. If you didn't do the butterfly, if you don't have the butterfly, you get the difference, right? It's just these right here. That's the only real difference in the trade, but everything else will illustrate essentially the same. So I am up again, kind of that same range, up about $2,500 right now, with about $1,400 of extrinsic still sitting out there. About a half hour to go in the day, so we will see here. Just kind of burning time, guys. No, Dino. That the butterflies at this point in the day are pretty tough to manage. I put a few bucks into it, and it's money that's coming out of the credit trades that we've done here. So either way, I just ride that to expiration, and we'll see what it looks like at the close. But no real management of it. Firehorse, that's exactly what I did. It is in the trade tab. I did put it in the trade tab, so you can take a look at it. But mine was a long butterfly. Just 15 minutes to go in the trading day, and I don't know what the probabilities are of finishing right here inside the tent on that butterfly. But that would be a crazy profit. That would be about a $4,000 profit on the day, all said and done, on about $33,000 of capital. That's pretty good. You know, it's a low likelihood, obviously, right, that we're going to finish right inside of. Let me go over to my screen, show you what I'm looking at. Low likelihood that we'll finish right in that tent area, but you never know. You never know. I know. I need some. I need some of Fred's luck today. So we'll see. We'll see. But just 14 minutes left to go in the day. So again, we start getting here down to the wire, and we know that the market can always make a push one way or the other, up or down. It looks like it's trying to push up right now, but we know that that happens going into the close. Fortunately, we're pretty well positioned right now. In fact, with 14 minutes to go in the day, honestly, we couldn't be better positioned. So this is really, again, if you're going to ride it into expiration, which was not my intention today, I really did want to book the profit here much earlier in the day, and probably had, in retrospect, probably had two opportunities to do that at a decent capture rate, an 80% capture rate. There's nothing wrong with that, for heaven's sake, and just didn't do it. And the opportunity was gone pretty quickly. So here we sit once again, riding it into expiration. But again, we could not be better positioned here. About 13 minutes or so left in the day. Couldn't be better positioned than where we're at right now. And I'm showing about $3,500, $3,400, something like that right now, open profit, with just a couple $100, just a couple $100 of theta left out there. So, obviously, number one, we would like it to finish inside the green, right? That's critical, that's key. But then number two, it'll be interesting to see if the butterfly can come into effect here and help give us a little bit of a boost to our profits also. So about 12 minutes now left to go, 11 and a half minutes or so. So we'll just tentatively wait and see where we end up here in just a few minutes. Okay, we're getting there. We're getting there. Just 3 minutes away from the close. It will be interesting to see if we can drop it inside of this tent, this profit tent on our butterfly in terms of what that would do profit and loss for us. You can see right here about $3,700 profit right in this range right here, about a $4,100 profit up in here. So it's substantial if we can get up there in terms of how much more percentage wise we get on the trade. But of course, the main thing is that we just finish in the green, right? And either way, I think it's going to be a pretty good home run for us. We're about 2 minutes away now. Air Force One, you had a question on BYND. That it just will expire today. We will reset on Beyond Meat tomorrow. Take a look at it then. 690. So that butterfly is still going to be potentially responsible for $500 of profit. I put up $300 to do that trade. It could add another $500 of profit to the trade. So in about half a minute, in 30 seconds, we'll know or not if that was a genius move. But right now, it's pretty darn good. This would be a big day. I'm showing over $4,100. Well, now my extrinsic value is all off, so we'll have to look at that. We'll have to look at it in the history tab. But I think that this is correct right here. About $3,700 profit. So there we go. There's the bell. Something, it's going to be something in the range of $3,700 profit on a $33,500 investment. That is just out of the park. That's out of the park. Fred, I think it is around 12%, 13%, something like that. So awesome day, guys. We Okay, so I don't know if that clip is in the right place or not, or if it even deserves being in this video, but I just wanted to show the power of a hedge, or more importantly, the power of trading around an existing trade. So that's a trade right there that I put up $33,500. I brought in $3,700 in profit in a day, but about $500 of that $3,700 profit was off of a $300 hedge or a $300 overlay. So I put up $33,500 to basically bring in, around $3,000. I put up another $300, and that netted an extra $500 profit. So 300 in, 800 out. But there was 400 additional profit dollars of potential in that butterfly. That $300 butterfly had the potential to make a $900 profit back. It didn't hit it because it didn't land right inside the tent, but it still provided an extra $500 of profit. And so it's important to hedge. And the reason that I stress this is that this program has been up and running long enough now that the questions that I get are now just recycling. They're sort of the same questions over and over, which is how it is in every field or aspect of our lives, right? There's no new discoveries being made. There's just the same issues, same challenges over and over again. One of the perennial conversations that I have is that, hey, Scott, my 0-day to expiration trades are not working for me. I'm not making money with my 0-day to expirations. And I'm doing the same thing that you're doing. Okay, now that's the key part right there. My 0-day to expiration trades are not making money. They're not working for me. And I'm doing exactly what you're doing. Now, I can't tell you how many dozens and dozens and dozens and dozens of times I have had that conversation. And to date, not one single time has that statement been true. And when I say it's not been true, what happens is we start delving into their trades. So, well, let's figure out what the problem is here. Let's delve into your trades. And what happens is one of two things. Now, the first thing that happens is that you're not trading what I trade, but you're doing it on purpose. You are, looking at the trades that I'm doing, and then you're basing your trading off of my trades. So maybe you're doing a little bit different position sizing, or you're doing a little bit different strike prices with different deltas, or maybe in some cases you're eliminating a leg, right? I'm doing a call leg, and you say, I don't want to do the call leg. I'm just going to do the put leg. I love that. I absolutely love that, because that's really what this system was designed for. That's why I built this system from the ground up, was to educate individuals to the point that they're like, listen, I could use some guideposts and some direction, but I know what I'm doing, and I'm capable now, and I can, think for myself. Heaven forbid we think for ourselves, right? Rather than just take rote trades from individuals that we never maybe even met in real life. So I love that, the idea. Now, that being the case, let's understand that our trades, your and my trades, are never going to be the same results, right? And if we look at the law of large numbers, it's probably 50-50. There's probably 50% of the time where I'm like, man, I should have done what you did, and I would have had a better result. And there's probably 50% of the time where you're like, yeah, I should have probably stuck what you were saying and done what you did, and I would have had a better result. But nevertheless, that's fine, right? That's not the situations that I'm talking about. The situations that I'm talking about are where individuals say, whether they feel like they are or not, they feel like, yes, I am doing the very same trade that you're doing. I'm not getting the same results. And we delve into it, and it's not even close to the same trade, because they're not trading around the trade. Okay. Now, I went back and forth with an individual that's like, yeah, I get your hedges, and I get all that, and I get the adjustments and the enhancements and all that kind of stuff. but your 0 day to expiration on that particular day was not profitable. You did not make money on your 0 day to expiration trade that day. Okay, again, the mindset just that one trade must stand alone. It must stand on its own 2 feet. It cannot be combined with another trade. Well, if that in fact is the reality, and if in fact that is the way that you think, doesn't that make sense that every spread trade is a loser then? Every single spread trade is a loser, right? Let's jump in. Let's look at my account for just. So I just jumped in here and I've already got TLT loaded up. Let's look at TLT because it's an interesting play in today's marketplace, right? This is obviously the 20-year Treasury bond, the ETF that tracks them, and of course it's just been absolutely decimated, really going all the way back here to last summer, last August. It has been an absolute free fall, but really precipitated this downdraft at the start of this year, 2021. And with the exception right here, of that one little blip, and you can see that our MACDs and our histograms didn't confirm that, we're really just now starting to get our first buy signals. You can see that the stochastics are starting to cross over and move from oversold and give us a buy signal. And you can see right here, man, our histogram just getting ready to break to the positive, right? And our MACD is just getting ready to cross over and head up as well. So anyway, first real buy signal that we've had in this for a long time. Let's just say, for example's sake, now guys, again, this is not a real trade. I'm not telling you to do this trade. I'm not recommending this trade. I'm just using this as an example, okay? So don't go queue this trade up and go trade this trade. But let's just say that we look at TLT and we're like, oh yeah, this thing's bottomed out. It has nothing but upside in it. And so I want to sell a put spread against this thing. And I'm going to come in here and, it's 139, almost 140 now. I don't think it's going any lower. I think it's just going to go higher, right? So I'm going to sell this 139 strike price right here, this put. And then I'm going to come down here and I'm going to buy this 136. Now, if you look at the numbers of this trade, it's kind of an interesting trade, right? It's a little bit low on the probability of success. I mean, we know what this would look like here in the risk graph. As long as TLT stays above 139 over the 10-day period here, we would be in the profit zone on this trade, right? So we understand kind of how the trade works. And yeah, that might be a little bit low on your probabilities of profit, but we feel really good, right, that it's just going to head up. And the numbers on the trade are pretty darn attractive. You can see I'd bring in $85 for every $215 that I would put up. Now, what kind of rate of return is that? And is that good? 85 divided by 215. Again, these are gross numbers, not counting commissions. It's almost 40%. 40% rate of return in 10 days. Yeah, that's pretty good, right? So let's say now that this trade works. Let's say that 10 days comes and goes. TLT finishes above 139. We make 40% on our money. There's one of two ways that you can look at this trade. You can say, oh my gosh, this trade made a 40% rate of return. It had almost a 70% chance of success. I was risking what? Not even 3-to-1 ratio, maybe a 2.6, 2.7 to 1 ratio. So not bad on the risk-reward ratio. And again, the ROI, the rate of return on it was amazing. So, I think most of us would be happy putting up $200 and getting $80 back, right? 40% rate of return, not too shabby. Well, that's one way to look at the trade. The other way is to say, well, yeah, technically you made money on the trade, but you also, 50% of the trade that you did here lost money. Isn't that true? I mean, 50% of the trade that we put on here lost money. Yeah, we made money here on the 139 strike price that we sold for $1.34. We made money on that, right? But this 54 cents that we spent on the 136 put, the money that we spent on that, we lost every penny of that. We lost every penny of that. So 50% of your trade lost money. And here's the interesting aspect with spreads. Whether it is a put spread or a call spread, whether it is a credit spread or a debit spread. 100% of your spread trades have a 50% loss inside of them, right? Or 50% of the trade inside of 100% of the trades loses money, right? And it loses money to the tune usually of 100% of its potential, right? How much of that 54 cents did you lose in this trade? You lost it all. You lost it all, right? So is that fair to say that every spread trade that you do of any kind, of any nature, credit or debit, put or call, 100% of the time, one of the legs is going to lose 100% of its value? So every single trade you do, half the trade is a losing trade. Well, we don't look at that way, do we? We combine these two trades into one trade. We look at them as a whole. We don't look at this trade and say, I brought in $1.34 and I spent 54 cents. We say I netted an 85-cent credit. Can I get out for a debit of 84 cents or less? And if we can, we are in the green. We're in the profit, right? Okay, the reason that I belabor this point is that the ideology that, well, your 0 day to expiration, though, it didn't make money on a standalone basis. Guys, your 0 day to expiration trades are going to be done typically, if you're using a 15 delta or so, at around what? A 60 to 68% probability of profit. And you're putting up $9 to make $1. So you run the math on that, and you tell me if a trade works 65% of the time and you're putting up $9 risk to make $1 profit, will that work out over time? Not without adjustments, not without enhancements, and not without delta hedging. Okay, so I want to get into, again, the concept of hedging and just simply what it means and how it works, because it is really the simplest topic to ever discuss with credit trading, but it is the hardest one to sort of absorb sometime, right? So let's just say that we're doing a trade, and again, let's just say this is our profit and loss line, okay? There's profit, and there's loss. And let's say that we're doing an iron condor, and it looks something like that, right? We get kind of what an iron condor looks like. Everything above here is the profit zone. Everything down here is the loss zone, right? Or excuse me, let me get at, that's not the loss zone, that's the profit zone. Outside of that, correct? Out here would be the loss. Okay. So what happens? We put this trade on, and the stock, or whatever underlying we're trading, ideally it's probably right in there, right? But as the day goes by and things change, that position changes. And you know, maybe where we started the day right here, now at middle of the day or later in the day, that stock is up in here. And all of a sudden, what looked like such a balanced trade for us is no longer a balanced trade, is it? And so we have to figure out some way to delta hedge. And when we talk about delta hedging, I've got a video on my YouTube channel, 13 different ways to hedge a trade. There's all kinds of different ways to hedge a trade. But the real idea is to get back to as delta neutral position as possible. The real idea is to do something, do anything with this trade. Let's sell more puts. Let's sell more calls. Let's buy more puts. Let's buy more calls. Let's do something to try to move this risk graph so that the risk graph can now kind of looks like this again, right? So that we're back centered on that trade. Now, there's a couple of ways to hedge, just theoretically. There's dozens of ways to hedge. I've listed 13 of the most popular in a training video on the website, but on the YouTube channel. But there's two sort of philosophies. There is defensive hedging and there is offensive hedging. Okay, now defensive hedging is just maybe rolling a leg. Maybe it wasn't a very egregious move, and we, would only incur a very teeny tiny loss on our call leg right here if we just rolled it out a little bit more. Okay, and we do that, and it gives us enough safety. And it diminishes our profit potential in the trade, but it doesn't take away from getting a profit. It still allows us to have a profit. It just diminishes it, right? That's a very defensive sort of hedge, if you will. But there are also offensive hedges. These are hedges where you're like, man, you know what? Not only is this thing going to break up here close to this call leg, it may very well break right through it, right? And we need to be a little bit more offensive in our hedging. Well, there's a couple of ways that we generally would do that. One is simply buying some calls, right? So we've got some short calls right here that are getting pressured by this move. We could simply buy some calls that would offset that. As these short calls lost money, the long calls that we owned would make money, and we could do that at a ratio where it would offset, right? And that's probably the most powerful. That is the most powerful hedge, is buying options that would help you in the direction of the move. If it was moving down, obviously we would buy puts, right? Here's why I don't like that trade that often, and here's the problem with just options in general, especially when we're day trading, when we're zero day to DTE trading the SPX. When is that option going to expire? Well, it's going to expire that very day, right? So you have now two issues in front of you. Now you've got a trade that is losing you money, and the hedge that you've just spent money on, that could potentially lose you even more money now because it expires right along with the trade. Plus, it has theta erosion. Now, I just said that it expires, but expiration and theta, those are two different things, right? Theta is the erosion of the value of that position over time because of the passage of time. Expiration is that darn thing goes away, right? It's not just losing value, it's gone. You can't trade it anymore. It has expired. And then the other issue with options is they're not one-to-one deltas. And so sometimes you have to overspend to get a proper hedge, because if you're using a 60 delta to hedge a position that is moving at almost a one-to-one delta, you understand that you're going to have to overpay for that insurance, right? So options are the most powerful way to hedge a big move, but my favorite way is using the futures. Now, depending on your account size, it might be the micros, it might be the MESs, it might be the minis, the ESs. Doesn't matter. That's irrelevant. That's all a position sizing issue. I don't care if you're using the MESs or the ESs, but I like those as a hedge because, number one, they have a one-to-one delta move. Number two, they don't expire. Now, the futures contracts do come and go, and we can roll those. Those are fine. But these are usually at the most a week-long position. We're not generally worried with expiration. So I'm going to go ahead and just say we don't worry about expiration, right? So one-to-one delta, we don't worry about expiration. We don't worry about theta erosion. If my hedge didn't work today, I don't need to worry about it being worth less immediately when the market opens up the next day because of theta, right? So I prefer those types of hedges. Now, I mentioned that on Friday of last week, I lost $14,000. I want to show you the results of the hedge that I used to work around. So one of the things that I always strive to do is be, number one, transparent, and number one, be real, using real dollars in a real account in my name with real results, good, bad, or indifferent, right? I mean, for heaven's sake, here we are in a video talking about my wonderful loss of $14,000 over last Friday. So I don't know that you can be more real than that. But this is the MES hedges that we started with on the 5th, and we ended up closing out today for not quite 14,000 exactly. You got a couple $100 of commissions in there, but about 14 grand. For all intents and purposes, we recovered all of those losses in a couple of days trading. And again, we've had some help with the market. That's one of the reasons that I like the futures as a hedge, because I don't want to deal with expirations. Could I have gotten my money all the way back in one day? Maybe. 2, 3 days, a week, 2 weeks, 3 weeks? I don't know. I don't know what the market's going to do, but I feel comfortable that I have a pretty darn decent shot at it using the futures as a hedging vehicle. And so trading around a trade, guys, trading around a trade. It reminds me of this, right? Now, I am not a chess player. My chess skills are rudimentary at best, but I appreciate the game, and I understand the skill level that it takes to be good at the game. And I know talent when I see it. And one of the things that I've always enjoyed with watching chess grandmasters or people that are really masters of the game is how they think about chess in a three-dimensional aspect, how they really view the game 3, 4, 5, sometimes 6, 7, 8, 9 moves ahead. Whatever they're doing right now was planned 8 or 9 moves ago, right? And great chess grandmasters will tell you, you always have to think ahead. Guys, in trading, if you are going to day trade, if you're going to do 0-day expiration trades, and you're not willing or not knowledgeable enough to adjust the trade. Now, we use all kinds of terms, right? We talk about adjusting trades. We talk about hedging trades. We talk about trying to maintain delta neutrality. We talk about enhancing a trade. I don't care what you call it. It's altering a trade. It's taking a static trade that you put on. If you're not willing or capable or able to adjust that trade, to alter that trade, what is your success rate going to be? Well, again, if we look at our historical numbers with our 0-day expiration system, placing trades at about a 12 to 16 delta, and never touching them again all day long, just letting them run and seeing how they work out, seeing whether they work or whether they don't, you're probably going to be successful somewhere around 55% of the time. Generally around 55% of the so just about half of all of the trades that we do require no adjustment. The other half, they do, right? So now if you say, well, I'm not going to adjust a trade, okay, you've got a system now that works 50% of the time and you're risking $9 to make $1. Is that going to work for you over time? Probably not. The numbers are probably not going to cash flow for you, right? So we have to be willing to adjust. And guys, ultimately, we get caught up in all different 13 adjustments and which one is better and when to use which one. Guys, ultimately, none of that matters. It's just delta neutrality. We're just trying to get back to delta neutrality. How can we balance out the delta? Are we too positive delta? Are we too negative delta? And what can we do to help offset that? Okay. So in my program, my 0-day expiration program, we're going to continue to try to build the core competency of all of us in here because this is new for a lot of us in our trading room. We're going to try to build that core competency of layering hedges on top of our current trades. And what's really nice are those days, and we've had a few of those here lately, where the hedge makes money and the trade makes money. You know, because insurance is not designed to make money, right? It's designed to protect. Hedges are not necessarily designed to make money. They're designed to protect. But there's opportunities where we can hedge and scalp throughout the day that position as it ebbs and flows inside of our cash flow zone and really enhance our profit. Think about that butterfly that I just did in this example here. $300 is how much money I put up to do that butterfly. Where did the $300 come from? It came from the $3,700 of credit that I brought in from my original 0 DTE trade. That was the credit. The $3,700 was the credit that I brought in from my credit spreads. So I'm not risking anything other than my potential profit. Okay, $300 is what I put up. It ended up bringing in $500 of profit. So a $300 trade turned into an $800 return, $500 profit on a $300 trade. That in and of itself is impressive, guys, but when I didn't have to come up with the $300 to do that, and remember, that was a broken wing butterfly, so it just didn't land inside the tent. Had it landed in the tent, that was another $400 profit potential on top of that. If you can do a trade that gives you the $300, put the $300 in, and have a potential to make $900 back, and you can do that every day, what does that do to your edge or your advantage in your trade? Everybody else is trading the same trade that you're trading and bringing in $3,000, and you have the potential to bring in $4,100. We're all doing the same trade every single day. Everybody else has the potential to make $3,000. You have the potential to make $4,100. You're not taking any extra risk other than giving up some profit potential. making 3,000, you're making 4,100. Over time, who's going to be more profitable as a trader? Who has the edge? Who has the advantage, right? So hedging is critical, guys. It's absolutely important in what you do.